Welcome back to the deep dive. If you're deep into studying for the investment funds in Canada exam, well, there's a mountain of information.
There really is.
So think of this deep dive as your essential guide to the core economic principles, the stuff that really forms the foundation for, well, so much of what you need to know.
Exactly. And our goal today isn't just to list definitions.
Hmm?
We want to break down these fundamental economic ideas, make them clear, make them memorable, especially for when you're looking at those IFC exam questions.
Right, so we're focusing on what's really relevant for you. The basics, micro versus macro, who's who in the economy, supply and demand.
Economic health, recessions,
Yeah.
the job market.
Yeah, the core building blocks. We want this to be a real boost for your prep.
Okay, let's jump right in then. What exactly is economics? Can we boil it down?
At its absolute heart, economics is the study of choices. Specifically, how we allocate limited resources, things like time, money, materials, to satisfy, well, basically unlimited wants and needs.
Limited stuff, unlimited wants, that sounds familiar. It's the human condition, really. And because of that fundamental imbalance, economics, as a social science, looks at how everyone, individuals, companies, governments, makes decisions under those constraints.
So it's about figuring out who gets what, how things are made, and how they're used, given we can't have everything.
Precisely. You've nailed the three core concerns: production, making stuff; distribution, getting it to people; and consumption, how we actually use it. You'll see these themes pop up again and again in the investment world.
And the big reason we have to make these choices is scarcity, right? That's the fundamental problem.
Absolutely. Scarcity is the name of the game. Resources are finite, wants are endless, and scarcity has a direct consequence, a really key concept: opportunity cost.
Okay, opportunity cost. Sounds important, likely exam worthy. Break it down for us.
Sure. Opportunity cost is simply what you sacrifice when you choose one option over another. It's the value of the next best alternative you didn't choose.
Like choosing to study for the IFC instead of watching a movie. The
Mhm.
movie is the opportunity cost.
Exactly. Or say you have an hour for IFC prep. You spend it on mutual funds. The opportunity cost is maybe not reviewing segregated funds or not doing practice questions. Every decision, big or small, involves giving something else up.
And for investing, choosing one stock means not choosing another or maybe not holding cash.
Precisely. It could be the missed gains from another investment or even the security you gave up by moving out of a safer asset. It's a constant trade-off.
Got it. And these decisions, they mostly happen within a market economy.
Yes, largely. In a market economy, decisions about what to produce and what things cost aren't dictated by, say, a central planner. They emerge from the interactions of millions of individual buyers and sellers.
Competition is key.
Very key. Competition between privately owned businesses, driven by the forces of supply and demand, is what shapes prices and production.
Okay, basics covered. Now, micro versus macroeconomics. I always want to make sure I've got this straight, especially for analyzing things relevant to the IFC exam.
It's a crucial distinction. Think of it like using a camera. Microeconomics is zooming in. You're looking closely at individual economic units.
Like one investor.
Or one company.
Exactly, or one specific market. How does a single household decide how much to save? How does a particular firm set the price for its product? What happens to the demand for, say, electric vehicles if the price of gasoline changes? It's the small scale.
Okay, zoom in. So macroeconomics is...
Zooming out, you step back and look at the economy as a whole, the big picture.
Like the entire Canadian economy, or maybe even global trends.
That's it. Macro deals with aggregate performance. We're talking about gross domestic product, GDP, the overall unemployment rate, inflation, national debt, and the big policy levers governments and central banks use.
So monetary and fiscal policy fit here.
Definitely. Fiscal policy, that's government taxing and spending decisions.
Yeah.
Monetary policy, that's the central bank, like the Bank of Canada, managing interest rates and the money supply. These are macro tools.
Can you give some IFC relevant micro examples, just to solidify it?
Sure. Micro questions might be: how would a 1% increase in the MER on a specific mutual fund affect demand for that fund? Or what impact does a change in capital gains tax have on an individual investor's decision to sell stocks?
Okay, very specific impacts.
Right. Or how does a rise in interest rates affect a single company's decision on whether to borrow money for expansion? Micro focuses on the individual decision-making unit.
And macro questions would be more like,
Why did Canada's overall GDP grow by only 0.5% last quarter? Will lowering the Bank of Canada's target interest rate stimulate nationwide business investment? How can government policy address persistent long-term unemployment across the country? See the difference? broader scope.
Yeah, definitely clear. Zoom in for micro, zoom out for macro.
Mhm.
Okay, who are the main players making all these economic decisions we should know about?
There are essentially three key groups of decision makers you need to keep in mind: consumers, businesses, and governments.
Right. Let's take consumers first. What's their main goal, economically speaking?
Consumers, that's all of us, individuals and households, are generally trying to maximize our personal satisfaction or uh, utility, as economists sometimes say. We do this within the limits of our budget, mainly our income.
So, getting the most happiness or value for our money.
Pretty much.
Okay.
Deciding what to buy, how much to save, maybe where to invest those savings,
Yeah.
like in investment funds, right? All aimed at achieving our financial goals and maximizing well-being.
Okay, makes sense. What about businesses? What drives them?
Businesses are primarily driven by the goal of maximizing profits. Simple as that usual.
How do they do that?
By using resources, labor, capital, technology, raw materials as efficiently as possible to produce goods or services that people want to buy, and selling them at a price that covers their costs and leaves something extra.
And in the investment world, they're also raising money, investing in projects.
Exactly. Issuing stocks and bonds, making capital expenditures, all with the ultimate aim of increasing profitability and shareholder value.
Okay, consumers maximize satisfaction, businesses maximize profit. What about governments? Their role seems bigger, maybe less straightforward.
It is multifaceted, definitely. Governments don't usually aim to maximize profit in the same way. First, they provide public goods and services, things the private market might not supply efficiently or at all. Think national defense, roads, the legal system.
Healthcare, education, too, often.
Right. Those are huge. Second, governments act as regulators and umpires. They set rules for businesses and markets. And third, they try to manage the overall economy, aiming for stable growth, low unemployment, stable prices, using those fiscal and monetary tools we mentioned.
So it's the constant interaction between consumers trying to get what they want, businesses trying to make a profit, and governments setting the rules and providing public services that shapes the whole economic landscape.
You've got it. And that landscape is the environment where all investment funds operate. The decisions of these three groups constantly influence market trends, risks, and opportunities. Understanding their motivations is key.
All right, moving on to probably the most fundamental concept, supply and demand. What are the absolute must-knows here for the IFC exam?
Okay, let's start with demand. Crucially, demand isn't just wanting something. It's the quantity of a good or service that consumers are willing and, importantly, able to buy at various prices over a certain time.
Willing and able, so you need the desire and the cash.
Exactly. Your desire for a private jet is infinite, maybe, but your effective demand is zero unless you can actually afford it. Ability to pay is critical.
Makes sense. And the law of demand. That's the basic relationship between price and how much people want to buy.
That's the one. Generally speaking, the law of demand says that as the price of something goes up, the quantity demanded goes down. And if the price goes down, the quantity demanded goes up, assuming other factors stay the same, of course.
Inverse relationship. Higher price, less buying. Lower price, more buying. Pretty intuitive.
It usually is. Think about a popular stock. If its price skyrockets, fewer new investors might be willing or able to buy in compared to when it was cheaper.
What else influences demand besides the price of the good itself?
Several things. Consumer income is a big one. More income usually means more demand for most goods, including investments.
Okay.
Consumer tastes and preferences, obviously. Trends matter. Then there's the price of related goods.
Like substitutes and complements.
Exactly.
Yeah.
If the price of a similar substitute investment product drops, demand for the original might fall. Complements are things used together, like printers and ink cartridges. And finally, expectations about the future prices, future income, can shift demand right now.
If you expect a fund's value to rise sharply, you might demand more of it now.
Precisely. Expectations play a huge role in financial markets.
Okay, that's demand. Let's flip to the supply side.
Right. Supply is the quantity of a good or service that producers are willing and able to offer for sale at various prices during a given period. Again, willingness and ability are both key.
So a company needs the desire to sell and the capacity to produce and deliver.
Correct. They might want to sell 1 million units, but if their factory can only make 500,000, their effective supply is limited by that ability.
And the law of supply goes the other way compared to demand.
It does. The law of supply generally states that as the price of a good or service increases, producers are willing to supply a larger quantity. Higher prices mean potentially higher profits, which incentivizes more production.
Higher price, more supply. Lower price, less supply. Makes sense from a producer's profit perspective.
hmm If firms can get a better price for their product, they're more motivated to make and sell more of it.
So we have buyers, demand, and sellers, supply. How do they meet?
They meet in the market, and their interaction determines the market equilibrium. That's the sweet spot.
Equilibrium, the balance point.
Exactly. It's the price at which the quantity consumers demand is exactly equal to the quantity producers supply.
Mm.
No leftover inventory, no unfulfilled orders. The market clears.
And if you draw the supply and demand curves on a graph, it's where they cross.
That's the visual representation, yes. The intersection point gives you the equilibrium price and the equilibrium quantity.
What if the price isn't at that equilibrium? Say, the price is too high.
Good question. If the price is above equilibrium, suppliers are willing to sell more than buyers are willing to buy at that high price. Quantity supplied exceeds quantity demanded.
So you get unsold goods piling up.
Right. That's called a surplus. And surpluses usually put downward pressure on prices as sellers try to offload their excess inventory. Think clearance sales.
Okay. And if the price is too low, below equilibrium.
Then you have the opposite problem, a shortage. At that low price, consumers demand more than producers are willing or able to supply. Quantity demanded exceeds quantity supplied.
Like long lines for a hot new product or empty shelves.
Exactly. Shortages tend to put upward pressure on prices, as buyers might be willing to pay more to get the limited goods available.
The surplus pushes prices down, shortage pushes prices up towards equilibrium. Got it. Crucial stuff. Now let's zoom back out. How do we measure the overall health of the economy, that big macro picture?
The single most cited measure is gross domestic product, or GDP.
Ah, GDP. Hear it all the time. What exactly is it telling us?
GDP is the total market value of all final goods and services produced within a country's borders over a specific period, usually a quarter or a year.
Final goods, so not the components used to make them.
Correct. We count the finished car, not the tires and steel that went into it, to avoid double counting, and its production within the country, regardless of who owns the company.
And why is it so important for investors?
Because it's the broadest measure of overall economic activity. Rising GDP generally means the economy is growing, businesses are doing well, people are spending, usually positive signs for corporate profits and investment returns. Falling GDP signals contraction, potential recession.
Okay, so GDP tells us how things are or were, but investing is about the future. How do we get clues about where the economy might be heading?
That's where economic indicators are vital. They're specific statistics that give us insights. We usually group them into 3 types based on timing.
3 types. What are they?
First, leading indicators. These tend to change before the overall economy changes direction. They can give us an early warning signal, potentially.
Like what? Give me some examples.
Things like building permits or housing starts are classic examples. Fewer permits today might mean less construction activity tomorrow. The stock market itself is often considered a leading indicator. Also, measures of manufacturing orders or changes in the money supply.
So they hint at what's coming. Okay, what's the second type?
Coincident indicators.
Yeah.
These move pretty much in step with the overall economy. They tell us what's happening right now.
And GDP would be one of these?
GDP is often considered coincident, yes, though it's reported with a lag. Other examples include things like industrial production, total employment figures, and personal income levels. They reflect the current state of economic activity.
Okay, leading for the future, coincident for the present. What's the third?
Lagging indicators. These only change after the economy has already started shifting. They confirm trends that are already underway.
Confirming what's already happened. Like what?
Yeah. The unemployment rate is a prime example of a lagging indicator. Businesses often wait to lay people off until a downturn is well established, and they're slow to hire again until recovery seems solid. Other lagging indicators include things like average duration of unemployment or corporate profits reported after the fact.
Understanding, which seems pretty important for interpreting economic news correctly.
Yeah.
Leading, coincident, lagging. Got it. Now, a big topic, recession. What's the official definition we should use?
Well, the rule of thumb you often hear is 2 consecutive quarters of negative real GDP growth. That's the simple technical definition.
But is that the whole story, especially in Canada?
Not quite. Statistics Canada, the agency that officially declares recessions here, uses a broader approach. They look beyond just GDP.
Yeah. What else do they consider?
They talk about the 3 Ds.
Yeah.
Depth, duration, and diffusion.
Depth, duration, diffusion. Okay, what do those mean?
Depth refers to how significant the decline in economic activity is. Is it a major drop or just a small dip? Duration means the downturn has to last more than just a month or two. It needs to be sustained. And diffusion means the weakness has to be spread broadly across the economy, affecting many industries, regions, and indicators, not just one isolated sector.
So it's a more holistic judgment call, not just a simple math formula based on GDP.
Exactly. They also look closely at things like employment losses and declines in overall economic output. So while 2 quarters of negative GDP is a strong signal, StatsCan waits for evidence of a significant, prolonged, and widespread downturn before making the official call.
That makes sense, a more robust assessment. Okay, let's shift focus slightly to the labor market. Employment numbers are always big news. What are the key stats here for the IFC exam?
2 main ones usually get the spotlight: the participation rate and the unemployment rate.
Okay, participation rate first. What's that?
The participation rate measures the share of the working age population, usually defined as 15 years and older. That is actively part of the labor force.
And the labor force includes?
People who are either employed or are unemployed, but actively looking for work. So the participation rate tells you what percentage of the potential workforce is actually working or trying to work.
What makes it go up or down?
Several factors. Demographics play a big role. An aging population with more retirees might lower the rate. Social trends, like more women entering the workforce over past decades, increased it. And of course, economic conditions matter. A strong economy might draw more people into the labor force, boosting the rate.
Okay, that's participation. What about the big one, the unemployment rate?
The unemployment rate is the percentage of the labor force, not the whole population, that is currently without a job, but is actively seeking employment and available to work.
And we said earlier, this is a lagging indicator.
Yes, typically. Businesses are often hesitant to lay off staff immediately when things slow down, hoping it's temporary. And they're cautious about hiring again during a recovery. So the unemployment rate usually peaks after a recession has already begun and starts falling, well after recovery is underway.
Right. Hiring and firing decisions have costs and lag behind the cycle. Now, I know unemployment isn't all the same. There are different types, right? That seems like definite exam material.
Absolutely. Distinguishing between the types is important. First, you have frictional unemployment.
Frictional, like friction in the system.
Sort of. It's the temporary unemployment that occurs when people are between jobs. Think of recent graduates searching for their first position, or someone who quit their job to look for a better one. It's natural and even healthy in a dynamic economy.
So some frictional unemployment is unavoidable and not necessarily bad.
Exactly. It reflects people moving to better suited jobs. Then there's structural unemployment.
Structural, what does that involve?
This type arises from a mismatch between the skills workers have and the skills employers need. It's often longer term. Think about technological change making certain jobs obsolete, or a major industry decline in a specific region.
Like manufacturing jobs disappearing and workers needing retraining for service or tech jobs.
That's a classic example. The structure of the economy changes, and some worker skills no longer match the available jobs without significant retraining or relocation.
Okay, frictional is short-term movement. Structural is a skills mismatch. What's next?
Cyclical unemployment.
Yeah.
This one is tied directly to the business cycle, the ups and downs of the overall economy.
So it goes up during recessions.
Precisely. When the economy slows down, demand for goods and services falls, businesses cut back production, and they lay off workers. That's cyclical unemployment. When the economy recovers, this type of unemployment tends to fall.
Makes sense. And the last type?
Seasonal unemployment. This occurs because some industries only operate or have peak seasons at certain times of the year.
Like ski instructors in the summer or farm workers in the winter?
Exactly. Construction, tourism, agriculture. Many sectors have predictable seasonal patterns in employment. This unemployment is regular and expected.
Okay, so frictional between jobs, structural skills mismatch, cyclical recessions booms, and seasonal time of year. Got those 4 clear. Wow, we've covered a lot of ground on these economic fundamentals today.
We really have. We started with the basics economics as the science of choice under scarcity, and that crucial idea of opportunity cost.
Right. Then we distinguished micro, the zoomed-in view of individuals and firms, from macro, the big picture of the whole economy.
Identified the key players, consumers maximizing satisfaction, businesses maximizing profit, governments providing public goods, and managing the system.
We dove into supply and demand, the core laws, what influences them, how they find equilibrium, and what happens with surpluses and shortages.
Yep. Then looked at measuring the economy with GDP and the different timing of indicators leading, coincident, and lagging, which help us interpret economic data.
Plus, we clarified the definition of a recession, going beyond the simple GDP rule to Statistics Canada's depth, duration, and diffusion criteria.
And finally, unpack the labor market. Participation rate, the lagging unemployment rate, and those 4 key types of unemployment: frictional, structural, cyclical, and seasonal.
It really feels like these concepts form a necessary foundation for understanding investment funds and how they perform in different economic conditions. Absolutely critical for the IFC exam.
Couldn't agree more. Having a solid grasp of these principles gives you the framework, the context for analyzing investments, understanding market movements, and interpreting financial news.
So as you continue studying, really try to connect these dots. Ask yourself, for example, how might a change in leading indicators, like a drop in housing starts, potentially affect investments in the real estate or construction sectors down the line?
That's the key, applying these concepts. Keep these fundamentals in mind as you prepare. You've taken a great step by digging into this with us today.
Absolutely. Best of luck with your continued IFC exam preparation. Thanks for joining us on the deep dive.
Yes, good luck, and we hope this was helpful.